So today I have a stock analysis of Palantir, one of the most polarizing stocks in the stock market for the past 5 years since they've gone public in 2018. So we're going to talk about this stock. We're going to look at the revenues, the cash flow. We're going to take a look at their leverage on their balance sheet, look at their value creation. Are they creating value by being in existence through their operations or not? And take a peek at their valuation and give a synopsis of where the company is right now based on their actual financials, not based on the hype. So let's get into Palantir. So I'm bringing up the stock price now, or the ticker. So we see Palantir, they went public in 2018, had a major dip here in 2022 and 23. Now we see they kind of trend up in a positive direction as they have become profitable and showing signs of consistent profitability. We'll look at that in a few seconds. So that's why you see this stock increase for Palantir. Palantir right now is at $72 billion and right now trading very high at a 190 PE. That's an extremely high PE ratio, but we'll look to see if this PE makes sense based on the results of the business. So let's look at the revenues. Looking at the revenues, we have, so they went public in 2018. I want you all to know, I understand they're fairly new to the stock market, but this company started in 2003. 15 years later, 2018 is when they went public. So we have $595 million in revenue in 2018, all the way to 2.4 over the past 12 months. So half of 23, half of 24, they're at $2.4 billion. So over the past 5 years, they've had a pretty solid growth rate, average growth rate of 25.4. I consider that to be a high growth company. So revenues are looking good. They're trending in the right direction. Now I want you to notice how we have this 24, 47, and 41% growth rate, but now we're starting to see a slowdown, 23, 16, and 11. So it looks like the company hit a stride and now they're kind of slowing down. Even 11.4% is still solid, decent growth. However, not as much as in 2020 and 21. So we're going to keep that in mind. So we see a 25% growth rate, and we see that the growth is starting to tail off over the past few years. Gross margins, how efficient is this company? After they make their product or deliver their product, what's left over? We see that they had solid margins of 72% in 2018. And what we like to see, especially with tech companies, we like to see those margins increasing over time. Small dip here in 19 and 20, but we see all the way up to 81.4. That is really great. Pretty amazing to have those solid, strong margins and that are improving over time. Profit margin, how profitable is the business? So we see 2018, a 97.4% negative gross margin, where we see consistent growth all the way up to 16.3. Great growth. Of course, you want this to be higher, and I expect this to go higher as the company continues, being that they're in a tech world and they should have more efficiencies as their R&D begins, or research and development efforts begin to pay off later on. So this is great trend. So overall, revenues and margins look pretty solid. Could be better in the profit margins, but still pretty good, trending in the right direction. Absolutely. Now let's go to free cash flow. How much cash are you generating through your operations minus your capital expenditures? In a company like Palantir, it's a tech company, so they're not going to have a lot of capital expenditures, but we want to see what that free cash flow is. So similar to the profit margins, we see that they were in the negative, had a spike in 2020, but then we see consistent growth, a little dip here, but overall consistent growth going in the right direction. I want you to note something similar to revenues, how we had a pretty solid growth and the growth started to tail off. We see this right here. We have right now negative growth of free cash flow of $696 million. So we see a similar trend where some of that growth is getting restricted. And when it comes to cash flow, so far in 2024, they're not earning as much free cash flow as they were in 2023. So we'll see how that trends in the future. But overall, free cash flow, I think is pretty good. 28% annual growth rate year to year. That's pretty solid. So that looks good. Now let's look at the balance sheet. How much debt do they carry and how fast can they pay off that debt? So we see, again, a positive trend. We see that debt going down. 396 all the way down to 175, $175 million worth of debt. Compare that to their cash flow for year to year. We see that they were in the negative position or bad positions in these 2 years, 2019 and 2020. But we see they turned that around and in great positions here, being able to pay off their debt in 1.1 years or less. So that's pretty good comparing debt to free cash flow. Average 2.2 years. They average being able to pay off their debt every 2 years. Solid position of solid balance sheet, I would say right there. So that's pretty good for Palantir. Didn't expect this to be in such a good shape. However, I want you to understand something. When a company like Palantir, they haven't been profitable a lot of years. They were first profitable in, let's see, 2023, this past year. That's right. They haven't been profitable this past year. So when companies are not profitable, they have to get cash from somewhere to continue to run their business. They typically get their cash through debt, taking out more loans, or selling shares. And that's something that we don't want for a company to sell an excessive amount of shares. I understand for that business, it may be great because they're bringing in cash without having to pay an interest expense. So it's pretty much free money for them. But to the existing shareholder, you're being diluted as they create more and more shares and selling it to the public, bringing in, as I say, they're bringing in too many people to the party. It gets crowded. I don't want that. I want people getting kicked out the party as I'm a shareholder. That way the value of my shares increase as they sell shares increase as they buy shares back instead of selling shares like Palantir is doing, as we're going to see in a second right now. All right, shares outstanding. Notice this trend increase of shares going up from year to year. So every year they've added to the outstanding number of shares. They're added shareholders. So they're pretty much adding owners of the business. So when they do that, yes, they get cash, but there's more people having a claim to those revenue and a claim to those cash flows. So this is not something we want to see in the business. Understand sometimes newer companies are doing this and it may make sense for their operations. But remember, this company has been around since 2003. It's not the newest company out there. It's just new to the public as we are able to buy shares since 2018. But this is not something you want a company that's been in existence for over 20 years to have this steep of a trend of selling shares. So that's not what we want to see with a business. But again, that does make sense looking at the rest of their numbers, given that their debt is coming down. So this is what they're doing. They're making some profit now, taking some of this cash flow, paying down debt, but then selling shares and bringing cash in that way. That's how they survived since 2018, since they weren't able to do it based off of margins. But again, they're in the profitability state right now. Hopefully they can grow that. So let's look at value creation. So understand that when we talk about the value creation of a business, you have your revenue, then your costs, and you have your profit. So a lot of people just look at that and see whether they're making money or losing money and then go from there. But then we can take it a step further to look at how much money did it actually take you to bring in that revenue or bring in that profit? Not just the cost of goods sold, but also the debt and the equity. Because of course, you're only bringing in cash from shareholders and you're only getting debt to operate and run your business. So based off of that, are you actually building value in your business, comparing the return that you're earning from the debt and the equity that you used to deploy that cash into the business? So this is what we want to look at. Look at return on capital employed. How well does management deploy capital to create a return on the money? And we want to compare that to the cost of capital. With the debt, you have a cost, and that's your interest expense. With equity, you have a cost, and that's pretty much the opportunity cost of other things that you could have done with that money compared to putting it into the business. So we want to look at the average rate of that, compare that to the return, and see if you're actually building value with your operations of your business. So right now, return on capital employed, not good, very low. Based on their debt and their equity, they've only returned 3% on that money. That's not good. Since Palantir is a very volatile company compared to the stock market, their opportunity cost is going to be more expensive. When it comes to their equity, that's why they have a 14.6, so that's pretty high. This is their hurdle rate. They need to earn more than 14.66% to be considered a company that's actually creating value by having its doors open and running its business. They're not in a good position. They're losing 11.32% of value based on their debt and equity balance. Compare that to the industry average of the software of all of their competitors. Return on capital is 23% compared to a weighted average cost of capital of 9%. So the average company that they're competing with is earning or creating value of 13.28%, which means they're negative 24% behind their competition when it comes to pure value creation. So that's a big negative for Palantir. So as no surprise, as we talked about earlier with the high PE that they're trading at, looking at two valuation metrics, we look at price to free cash flow, a simple way of looking at how expensive is their cash flow, and the PEG ratio, comparing the PE ratio to the future growth expectation of the business. So right now, the market cap is at $72 billion, free cash flow of $696 million. That means this company is trading at 104 times their free cash flow amount. Meaning if you have $104 and I have $1 in my business and we trade that, you will be paying $104 for $1 of free cash flow. How much or how fast is that free cash flow growing for this to make sense? I would say it would need to increase at a very significant rate for that to make sense. We'll look at the growth rate in a minute and you can make your assessment on your own. With the PE ratio very high at 191, analysts are saying that this company can grow at 85% per year for the next 5 years. I think that's questionable, but just putting that in there, we see that they are trading, or the PE right now is trading at 2.2 times the expected growth rate over the next 5 years. So technically it's overvalued on both metrics. Now, let's look at this growth rate. If I go to Yahoo Finance and I go to the analyst tab, I can see that there are 13 analysts. Let me scroll so you can see it. Yeah, there are 13 analysts that have given their opinion, and this is just the aggregate of those 13 analyst opinions. 13 of them right now. If I scroll all the way down to the growth estimates, they're saying 85% a year, 85.1. Now, I want you to notice some things. We'll look at two things. Number one, they say next year is going to grow at 19.4%. Palantir themselves said that they're going to grow at about 27%. So as you see, the guidance from the company, a lot of times is going to be overstated because they always want to paint a rosy picture. But these analysts say that they're going to grow at 19.4%. Now, 19 is significantly different from 85. So this is telling me that if they were to grow at 19%, they have to grow at much higher than 85% for the 4 years after that so that they can average 85% per year for the next 5 years. So is that going to happen? Is that likely? Looking at the business so far, I don't see growth that high. 47% is the highest that they've grown in a year. And that was only 1 year in 2020. Ever since then, they've dropped significantly from this point. So yeah, they're technically high growth, but that's looking at the 5-year average. If you were to look at the last 3 years, they're not at 25%. Especially if you consider the last 12 months, they're not there. So how can I believe that they're going to grow at 85% for the next 5 years? Now, they do have a lot of government contracts, and apparently there's a lot of contracts that may be gearing up for the next 5 years. So you would have to do some research and figure out what are those contracts, what are the value of those contracts, and are they on target to start those contracts on time for this investment to make sense. Now, if you're dollar cost averaging and you have a long-term positive view and believe in this company, then this doesn't matter. But right now, for many investors who are looking to put a lump sum into an investment, these two tabs, the value creation, they're losing value, and you have to figure out when is the point in time where they'll begin to create value versus lose. And then the valuation, it just doesn't make sense to invest in a company. This is my opinion. to invest in a company trading at this high valuation with a growth that's starting to tail off. So I understand there's a lot of hype beasts about this company. Personally, I like to look at the numbers. I like to make my decisions off of the numbers. Any company can sound great just talking and being excited, and just human nature, you always want to find that next big opportunity. So you're going to be more prone to accept a hype story if you just listen to the story versus looking at the numbers. And this is why I do this. I want to know, is the company actually performing well before I call it a great company? Are they earning a return in a margin that their competitors are not earning? That's the only way that you know a company is actually better than another one. Can they charge more for their product, for the same product? Can they earn better margins for the same product? If so, then maybe that company actually is superior. I need your cash flows to be more superior. I need your returns to be more superior. Other than that, it's just talk and it doesn't matter. So the whole point of these videos is to show people what the company is actually doing versus what people are saying about the company. So I want you to keep that in mind. So we always make decisions based on the actual results of the business. You do not have to rush and make early decisions on businesses. You actually can wait to see if they are the true winners and then invest in them then. You may be missing out on some gains, but you're taking on so much risk by doing that. So we always want to be mindful of risk, always want to be careful, and we want to make sure we're investing in companies that make sense for us to invest in. So just looking at this brief scorecard, revenues and margins look pretty solid. Free cash flow, pretty solid. Of course, balance sheet, we see that they can pay off their debt pretty fast. No dividend right now, but why can they pay off their debt so fast? And how come their debt balance dropped so significant? It's because they're selling a lot of shares and bringing in cash that way. So don't just look at the balance sheet and say, hey, they have low debt, they're in great position. They're selling a lot of shares, increasing the share count and diluting you as a shareholder is what they're doing. They're not creating value. They're losing value right now, and they are not properly valued. This business is currently overvalued. So just a brief snapshot of what I think about this business, Palantir. Is it a great business? Right now, there are some pieces of the business that seem like it could be a quality business in the future. When I consider quality, I just don't want to see something that's good. I want to see something that's good for a while, and also that has I believe that trend will continue. There aren't any competitors that can pretty much blow them off of their horse. Right now, I can't say that I'm confident that there's no other business that can start doing what they're doing. Again, they take data and they help businesses and governments make decisions. To say that they're the only ones that can do that, maybe there's some things that they're doing that are unique. But again, this is something that you have to learn by really digging into the financials and the industry and understanding the company. So with that being said, I hope you enjoyed this video. I hope you have a better understanding of Palantir's actual results. And let me know in the comments what other videos you'd like for me to review. And I hope to see you in the next video.